In this video, I'll go over some ideas of what to do with your money in this difficult economic climate, and we're starting right now. Hey guys, Elliot here. So you probably don't need me to tell you that it's been a rough year in the world of money and investing. As 2022 got going, stock market was on the way down and interest rates were on the way up. Soaring inflation is on everyone's mind as mortgages, cars, gas, and food have all gotten less affordable. And now the dreaded term recession is getting thrown around, with some economists saying that we're essentially already there. So let's take a step back and talk about what you should be doing with your money in this not so easy economic climate. As always, if you enjoyed this video and find it useful, please do consider subscribing to the channel and hit that notification bell so you don't miss any future videos just like this one. So the first thing to address is the 1,000-pound gorilla in the room, and that is inflation and the related sudden and dramatic rise in interest rates. So I guess two gorillas. Now, inflation itself has many roots, but part of it can be traced back to the worldwide disruption in manufacture and delivery of goods, which was all due to the COVID-19 pandemic. With strong demand coming back, the result was too many people chasing too few available goods, thus forcing prices to go up. Another reason was the Fed's long-standing policy of ultra-low interest rates. This was needed to spur the economy after the 2008 meltdown, but unfortunately it also encouraged excessive borrowing and increased the money supply. We didn't feel it as long as the economy kept growing, but as soon as it stopped during the pandemic, inflation dramatically spiked. Now, how do you combat inflation? Well, the biggest tool in the Fed's arsenal is increasing the interest rates. This will discourage borrowing and gradually wind down the money supply as people and corporations pay off debts instead of taking on new ones. Now, one thing the Fed can't control is worldwide logistic issues and all the pandemic-related delays and shortages. But fortunately, this is slowly improving, and it's likely inflation will be brought under control in the relatively near future. Meanwhile, here we are stuck with interest rates that are twice as high as even just 6 months ago. So what is the best course of action here? Well, there are two things to focus on right away. First off, and I can't stress this enough, work on paying off your debts as soon as possible. If you have any debt where the interest rate is variable, that rate will go up as a result of the Fed's actions. This will most affect your credit card balances as they're almost always variable, so if you're carrying a substantial balance on a MasterCard or Visa, this would be a good time to set aside major purchases, vacations, or non-essential home repairs and pay down those card balances. An interest rate rise of just several points will cost you hundreds or even thousands depending on how much you're carrying in your balance. Also, check if your student loans are variable. They often are, but you're probably okay with car loans as they're usually fixed. Okay, the next thing you can do when interest rates are on the rise is reconsider high-yield savings and money market accounts. They're a great place to stash your money and build up your savings, and you should have between 3 and 6 months of living expenses stored away. However, in the low interest rate environment we've had for such a long time, the savings returns weren't much more than 0.1%, which understandably is not going to motivate anyone to save. Now, however, with the prevailing money market and high yield savings rates inching closer to about 3%, it makes sense to again build up emergency savings. You still won't beat inflation, but it's a lot better than stuffing your money under the mattress. Okay, so these two items were on the subjects of debt and savings. What about investing in this environment? Well, as I mentioned earlier, despite most stocks not doing too well, it's not all bad. To see where you can put your money, you have to ask yourself, who benefits from rising interest rates? Well, banks certainly do, and that's due to the fact that their profit margins expand as the interest rates climb. The same goes for brokers and insurance companies, so it may pay to look into stocks from these types of businesses. If you're the kind of investor that doesn't mind a little bit of research, look for companies that are cash rich as they're earning a lot on their cash reserves. How do you find these? Well, just look for low debt to equity ratios and large percentages of book values in the form of cash. Also, this would be a good time to consider how good dividend investing is when there's a downturn. Dividend stocks, especially the higher quality ones, will continue to pay you monthly or quarterly dividends, even if their share prices dip. When you focus on dividend investing, you end up not paying that much attention to a bear market, or at least not stressing as much about it, since since capital appreciation is not the focus here. Now sure, dividends can be cut or discontinued. After all, nothing is guaranteed in life, but careful research of the companies will lower that risk. So what other opportunities are there aside from stocks? There are a few in the world of bonds that are paying out quite well these days. For starters, look into short-term government bonds called Treasury bills. They have maturities from just a few days all the way up to 1 year. And they're currently paying up to 4% with all the safety that government treasuries entail. You can find a lot of info on all types of government bonds at TreasuryDirect.gov. Another type of bond worth checking out is a Series I savings bond. They are currently paying a rather impressive 9.6%, but there are some downsides to consider. One is their long maturity of 20 to 30 years, and another is the fact that you can't cash them out in the first year at all, and then you lose a few months of interest if you do it between year 2 and year 5. However, if you can avoid cashing in the bond for 5 years or more, this is a very well-paying and safe investment and definitely worth checking out. Finally, I need to mention Treasury Inflation Protected Securities, or TIPS. TIPS are a type of Treasury security also issued by the US government, and they are designed to be indexed to inflation in order to protect investors in the declining purchasing power of their money. As inflation rises, TIPS adjust the principal in order to maintain their real value. More information on them can also be found at TreasuryDirect.gov. Okay, so that was a quick overview of what to do with your money when interest rates rise and the financial picture isn't as rosy. As you can see, there are things you should address in your personal finances such as debt and savings, and there are definitely opportunities in investing as well with both stocks and bonds. You just have to look a little harder. As always, if you enjoyed this video and found it useful, please do consider subscribing to the channel and turn on notifications so you don't miss any future videos just like this one. Thanks for watching, and I'll see you all soon.